Welcome to the Pro Tickers Deep Dive, your go-to breakdown of the stock movers and major stories at the close of global trading. Let's dive into today's market action. Today, we're really cutting through the noise, trying to understand some pretty seismic shifts reshaping our financial world.
Absolutely. And our deep dive today is based on insights from some really influential voices. We're talking former SEC Chair Gary Gensler, JP Morgan's Monica Dezano, and trade specialist Emily Kilcrease.
Yeah, exactly. And we're exploring a crucial question, really. How do you find stability when the ground beneath the market feels like it's constantly moving?
It's a big one. We'll touch on everything from the, shadowy corners of crypto to a new era of trade wars.
And how the world's biggest portfolios are adapting. Understanding these critical shifts in global markets and U.S. policy is, frankly, paramount for safeguarding your financial future.
No doubt about it.
So let's unpack this. We should probably kick things off with that rather blunt assessment from Gary Gensler. You know, former SEC head, now at MIT. He's not pulling any punches when he talks about stablecoins like Tether.
Not at all. He basically views them as financial tools increasingly used to move U.S. dollars outside the traditional regulated banking system.
Outside the system, yeah.
And a key takeaway here is his direct quote, which, wow, it really paints a picture. Stablecoins are nothing more than poker chips for crypto casinos.
Poker chips, that's strong.
It is. Gensler's arguing they effectively bypass traditional oversight and, maybe more importantly, offer no meaningful value to the holder beyond just facilitating these unregulated dollar transfers within the crypto world.
So just moving money around, basically.
Pretty much. And this prompts a really important question for you, the listener, to think about. If stablecoins are backed by reserves, supposedly, who actually gets the interest income from those reserves?
Ah, good point. Not like my savings account.
Exactly. Unlike traditional savings, where you, the saver, earn the yield with stablecoins, that interest often flows directly to the corporate issuers. Think Tether Circle, not the individual holding the coin.
So it's a hidden profit stream for them.
A significant one. It's a fundamental power imbalance, really. And beyond that, it funnels all this financial activity outside the reach of consumer protections, anti-money laundering rules.
Which could definitely create vulnerabilities down the line.
For the wider financial system, absolutely.
Okay, so that poker chips analogy,
Okay.
it really zeroes in on that speculative, maybe unregulated nature he sees. Now, speaking of strong words and significant shifts, Gensler, and he's not alone here, other leading economists too, are sounding a pretty serious alarm about these broad-based tariffs we're seeing.
Yeah, the tariff situation is something else.
We're looking at a staggering fourfold increase in average U.S. tariffs, climbing from, what was it, 2.3% previously?
Yeah, around there.
To now over 10%.
Yeah.
I mean, that's not just a statistic. It's one of the largest tax hikes in recent American history.
It really is. And digging deeper into this, what's crucial to get is that these aren't, narrowly targeted tariffs aiming at specific bad actors.
No, it feels much broader.
It is. These are sweeping across-the-board tariffs. And the worry among economists is that this kind of broad application could ultimately depress overall economic growth and, maybe counterintuitively, increase inflation for consumers.
Right, because costs go up everywhere.
Exactly. And what's maybe even more concerning is the potential for a disproportionate impact on, say, rural communities.
How so?
Well, think about areas heavily reliant on agricultural exports. New tariffs can just slam their markets shut, right?
Okay, yeah.
Combine that with other changes, like the rollback of Medicaid coverage, which hits healthcare access and spending power in these often vulnerable areas, and reduced immigration, limiting the labor force.
It really creates like a triple whammy.
A three-pronged hit, yeah, to the economic vitality of those regions. And Emily Kilcrease, the trade specialist we mentioned, she highlights how this administration uses tariffs not just for trade practices,
But for other reasons, too.
yeah, explicitly to generate revenue and to kind of force a realignment of global supply chains.
Okay.
Well, that's an unprecedented expansion of how these tools are usually used.
Wow. So revenue and supply chain engineering, not just trade fairness, that really changes the game.
Completely.
And that demand for transparency, especially when assessing risk, it isn't just in public policy, is it? We're seeing this massive shift in finance, too, away from traditional banks.
And into private credit markets.
Which have just exploded, right? A whopping $2 trillion space now.
Incredible growth.
But Gensler has a stark warning here, too. He notes, and I'm quoting, "These are long-term assets, often tied to higher borrowing costs. But valuations are murky."
Murky valuations, that's the key phrase. And the central question it raises is, How exactly are these massive private asset managers, the Apollos, the Blackstones, how are they valuing the assets on their
Right,
books?
it's not like a stock price you see every second.
Not at all. Private credit valuations are often less transparent, updated less frequently. It makes it harder for investors and, crucially, regulators to really assess the risk until, well, maybe it's too late.
So risk could be building up unseen.
Potentially.
Mm-hmm.
And while, competition in capital markets is generally healthy, Gensler cautions that moving this kind of risk out of highly regulated banks into these less transparent private credit vehicles, well, it might just open up entirely new vulnerabilities for the financial system.
It sounds like a classic case of risk migrating to the shadows, sort of.
That's a good way to put it. Migrating to the least regulated parts of the market. It definitely demands our attention.
Okay, that migration of risk is something we definitely need to keep a very close eye on. And this focus on risk and regulation, it extends to the global stage, too, especially when we talk about China.
Mm-hmm.
Gensler emphasizes that the current approach to China has become quite erratic.
Yeah, inconsistent seems to be the word.
He's advocating for a more consistent, maybe even more, well, respectful framework for engagement, especially around critical areas like trade compliance and data controls.
And what's really striking here, thinking about China, is their unique advantages in AI development.
How so?
A lot of it stems from just sheer population scale and, crucially, access to vast amounts of domestic data that really fuels its rapidly growing competition with U.S. tech giants.
Right. Data is the new oil, as they say.
Pretty much. Now, Gensler, he's cautiously optimistic about AI's potential for boosting productivity across economies.
But there's a but.
There's a big but. He also sounds a serious note of caution regarding the, frankly, inevitable job market upheaval that will follow.
Upheaval is a strong word.
It is. It's not just about some jobs being displaced. It's a potential earthquake hitting the employment landscape. It means massive reskilling, reevaluating entire industries. It forces us to think about how we prepare.
A potential earthquake indeed. And one that could impact so many of us directly. Which brings us neatly to the broader regulatory landscape itself.
Yeah, the whole picture.
There's a very clear swing of the pendulum happening, right? Particularly as Paul Atkins steps in at the SEC with a more deregulatory agenda.
Definitely a shift. And Gensler, ever the pragmatist, he just acknowledges this reality, stating simply, elections have consequences.
Didn't look true.
And he sees this pendulum swing not just as like a political outcome, but as a direct challenge to the very stability of our capital markets.
How so?
For him, stable markets are fundamentally built on clear, consistently enforced rules. Simple as that. He warns that a deregulatory push could lead to greater leverage across the system.
More debt, more risk.
Exactly. And critically, weaker investor protection, especially with the rollback of some consumer protection bodies we've seen. He even noted that the SEC itself has shrunk, staffing-wise, by a substantial 20%.
20%. Wow.
Yeah. A cut, he believes, and I quote, weakens our ability to monitor markets for fraud and manipulation. That's a significant reduction in the frontline defense against market abuses.
It certainly raises questions about potential risks to market integrity, maybe even trust.
It's a stark contrast in philosophies, no doubt.
Okay, shifting gears a bit here. Let's talk investment strategy. Monica DeZono, she heads global investment opportunities at J.P. Morgan Private Bank.
Right.
She offered a very candid assessment of how high net worth clients are adapting to all this.
What's she seeing?
She notes that U.S. clients are finally beginning to shift away from what had become really extreme domestic equity concentrations.
Like too much in U.S. stocks?
Yeah, she said some portfolios had drifted to as much as 75% just in U.S. equities alone.
Wow, that's high.
Very high. And now they're moving toward much more globally diversified holdings.
Interesting. So broadening out. She made it clear, though, this isn't about, abandoning the U.S. market entirely.
No, not at all.
It's more a recognition among sophisticated investors of the importance of balance, right? Broadening their horizons.
Exactly. They're actively looking at opportunities in Europe, Japan, even local currency-denominated emerging market debt.
Okay, so really diversifying.
But what's truly fascinating here, and it speaks volumes about shifting risk appetites, is how ultra-high net worth families, especially those managing, billion-dollar-plus balance sheets.
Really big players.
Yeah. They are now allocating more than 50% of their total assets to alternative assets.
More than half. Two alternatives.
More than half.
Ah,
That's a huge, deliberate move. It signals a clear shift away from traditional public markets for a big chunk of their wealth.
that is a powerful indication of where the smart money is heading, really diversifying beyond what many retail investors might typically consider.
Definitely. Now let's dig into the fixed income space a bit. Dizano says clients remain quite comfortable holding U.S. Treasuries.
Makes sense. Perceived safety, right.
Exactly. She also noted an increasing interest in municipal bonds, or munis, particularly with some recent volatility around, like, university bond tax status.
Okay, Muni's getting some attention. What about riskier debt?
Well, what's particularly noteworthy is that high-yield debt junk bonds basically is surprisingly lacking appeal right now
Really? Why is that?
because they're spreads. The extra yield you get for taking on more risk compared to safer government bonds.
Yeah, the risk premium.
Right. Those spreads have gotten so compressed, so narrow, that the reward just isn't seen as worth the risk for many investors.
Okay, so not enough compensation for the risk involved.
Precisely. But she did point out, for tax-aware investors, bank preferreds are offering pretty attractive high single-digit tax-equivalent yields.
Ah, interesting. So attractive, especially after tax.
Yeah, making them quite appealing, especially in this kind of broader market uncertainty. It's worth asking yourself, are you truly optimizing your fixed income portfolio for tax efficiency?
It's a detail that can make a substantial difference in your net returns. Absolutely.
For sure. Okay, finally, let's wrap up with trade policy again. Emily Kilcrease, with her background at the National Security Council, USTR,
Yeah, she's got the inside view.
she drew a very clear distinction about the current approach to tariffs. She stated unequivocally, this time around, the use of tariffs is faster, broader, and more chaotic.
Faster, broader, chaotic. That doesn't sound good.
Not exactly calming. And stepping back, what she really highlights is that while some of the grievances with the global trading system, particularly related to China's practices, might be legitimate.
Okay, so there are real issues.
There are. But the administration's current sort of all-or-nothing approach risks alienating key allies
Pushing partners away.
and, critically, undermining U.S. credibility on the world stage. Kilcrease believes the U.S. needs to rebuild that credibility, not just by threatening tariffs.
But by being willing to remove them, too.
Exactly. By making credible commitments to remove them when trade partners actually comply with agreed-upon terms.
A more nuanced approach?
Seems like it. She acknowledges realistically that there's no going back to a WTO-centered world order entirely.
The old system is gone.
But she emphatically stresses the urgent need for some kind of coherent rules-based framework that can restore a sense of predictability to global trade.
Because without that...
Well, without that, the chaos she mentioned could just become the new normal, impacting everything from supply chains to consumer prices.
Yeah, that's a sobering thought. So pulling it all together, from the changing landscape of stablecoins and the rise of private credit,
To the sweeping impact of new tariffs and how global portfolios are evolving.
the recurring theme across all these conversations seems crystal clear. We are navigating a period of really elevated uncertainty, both in policy and in the markets.
Totally agree. Inflationary pressures, the expansion of leverage in different parts of the system, political volatility, it's all fundamentally reshaping investor expectations and risk calculations.
It really is. For policymakers, the immense task at hand is this delicate balancing act, isn't it? Managing systemic risk while somehow still fostering crucial innovation.
That's a tough tightrope to walk. And for you, the investor, it really comes down to, well, proactive diversification, disciplined decision-making.
And just staying vigilantly informed. Can't stress that enough.
Absolutely. Which leaves us with a truly important question for you to mull over. How will these intertwined forces, these significant regulatory shifts, the escalating geopolitical tensions, and these constantly evolving investment strategies, how will they influence your personal financial resilience and your approach to wealth management in the coming year?
Something to genuinely consider as you navigate these, well, pretty uncharted waters.
That brings us to the close of today's deep dive. We hope this exploration of recent market movements and insights from top financial minds helps you navigate the complexities of global trading with greater confidence. Thanks for listening, and we'll see you next time on the Pro Tickers Deep Dive. Stay sharp and stay informed.